As a chartered investment manager and financial planner, one of the most important roles we play for our clients is picking the money managers that we utilize to run a portion of their portfolios. And there are 8 key attributes that are consistent among top money managers. Today, I'm going to share 4 of them with you. My name is Jon Williams, Senior Investment Advisor with Manulife Securities and Williams Financial Group. Last week, our team, including Wayne Gray and Daniel Greer, had our annual Due Diligence Day. See, the purpose of this is to do a thorough review of each of the money managers that we utilize for building our client portfolios. We compare them to their peer groups, talk to the portfolio managers, and ultimately get an update to determine if we're going to continue to use them in our client portfolios on an ongoing basis. Or are we going to fire them and replace them with another money manager? This other money manager might be more consistent in providing lower risk outperformance. I will share with you that in this process, we fired 1 bond manager and 1 equity manager. On average, we make 1 to 2 changes each year as a result of our due diligence day. Yet there is a core number of managers that haven't changed in the past 7 years. The next question is, what do we look for in a portfolio manager or mutual fund company for that matter, in order to consider them to be part of our recommended portfolio? As I mentioned, there are 8 key attributes that we look for, but I'll start with 4. In 2006, there was a report produced from the Yale School of Management called How Active is Your Manager? It focused on something called active share, which is a measure of how different a portfolio is to the index. The study concluded that the more active or different that the portfolio manager is, the higher the annualized out and or underperformance. So we look for managers with high active share and of course consistent outperformance. The next item is that we look for funds that have a relatively small number of businesses which reflect ideas of the portfolio manager of which they have high conviction. Because according to a research report published in 2010 called Best Ideas, funds that concentrate their holdings in the best ideas of those portfolio managers consistently outperform the market by 4 to 10% annually. The next item I will share with you is that money managers that focus on business fundamentals and not computer algorithms also outperform. In the same Yale study I mentioned before, funds that focus on stock selection had better returns than those that made market timing calls. It showed that in fact these calls aren't rewarded and actually destroy value to fund investors. Which, if we look at the overall industry and one of the most successful investors, Warren Buffett, you would see that this business purchasing or buying a quality business is part of the fundamental that he believes in and obviously has proven to work out extremely well. The last item I will mention that is fundamental is that money managers need to be on the same side of the desk as the investors. The way that we make sure of this is that the money manager owns a significant amount of their own fund. According to a research report done by Morningstar in 2011, of the 7,700 funds that Morningstar tracks, nearly half of the money managers who run those funds, they don't have a single penny in their own fund. In the same study, they also determined that money managers with a minimum of $1 million of their personal money in the funds that they manage historically outperform the majority of their peers over a 5-year time frame. My goal today was to provide some information and education on the qualitative attributes that we look for in money managers that make up our client portfolios. I hope you found this informative, and if you would like to have a further discussion on our process, feel free to call or email our office. Thanks very much.